A bank is like a place that lends you an umbrella when the weather is nice, but takes it back when the storm comes, then offers to sell you a raincoat and a pair of boots. This is a neat metaphor for how banks operate, an institution so familiar to us whether we interact with it regularly or not. And to some extent, both you and I are influenced by this system. Why is that? Let me explain a bit about how banks work, what their purpose is, and why they have such a huge impact on society. First, when we think of banks, we think of money, lots of money, or robbers. In fact, at the very beginning, banks were set up with three main functions: issuing money, taking deposits, and lending. Over time though, banks split into specialized institutions: policy banks that mainly support low-income households or special groups, investment banks that handle investments, underwriting, or advisory services, and many others. However, in today's video, we'll focus on commercial banks, these ones because, well, I like money. Commercial banks, as the name suggests, operate for commercial purposes and provide a wide range of financial services. Still, their most common activities are taking deposits and lending money. And of course, they take deposits at low interest and lend at higher interest. That's business. It has to make a profit. But here's the problem. People usually deposit small amounts of money for short terms, but borrowers often take out large sums for long terms. For example, Mr. D saves up $400,000 and deposits it in a bank, planning to withdraw it in 2 years with interest. The bank can lend part of that money to someone else at a higher rate. But then Mr. Z comes along wanting a $5 million loan to repay over 10 years. So where does the rest of the money come from? And how will the bank pay back Mr. D in 2 years?
Obviously, commercial banks don't have the right to print money. That's the job of the Federal Reserve, the Fed. Instead, banks generate cash flow by using economies of scale.
They gather money from many people, like Mr. D, to lend to borrowers like Mr. Z. Simply put, they pool small amounts into something big. Besides that, banks issue bonds, deal in foreign currency, charge service fees, and try to diversify their income sources as much as possible. Emphasis on try. We'll talk more about these revenue streams in future videos. Another way banks create cash flow is by depositing money into other banks. And if you're wondering whether banks lend out all of your money, you can relax a bit. Banks are required to keep a portion of deposits as what's called a reserve requirement. For example, if you deposit $10 million into Bank A, it must keep 10% in reserve and can use the remaining $9 million for other purposes, like depositing it into Bank B. Bank B also keeps 10% in reserve, using $8.1 million for other activities, and then deposits that into Bank C, and the cycle continues. That's how banks multiply the money supply in the market many times over. Most developing countries like in Asia, Latin America, Africa still use reserve requirements to control the money supply. But the US is different. Since 2020, the Fed has reduced the reserve requirement ratio to 0%. Instead, it manages the money supply and financial stability with other tools: policy interest rates, open market operations, and capital divided by liquidity requirements. This means US commercial banks must still remain financially safe, but they're no longer bound by the hard rule of deposit $10 million, keep 10% in reserve. Some business activities are banned for banks. For example, directly engaging in real estate or tying loan approvals to forced insurance purchases, because in the past some bankers abused their power to pressure borrowers. That was not good. On the other hand, US commercial banks are tightly regulated by the Fed, the Federal Deposit Insurance Corporation, FDIC, and state regulators, partly because of their unique nature, partly because of their enormous impact on the national economy. Put simply, banks are the largest source of capital in the economy. Imagine you have a pile of cash but don't know what to do with it, while someone in California needs money to build a house but doesn't know anyone with cash to lend. Boom. A bank steps in and connects the two of you. Another example, you still have cash sitting idle, and a stranger comes up saying they want to borrow it and promise to repay tomorrow with interest. They may look trustworthy, but you have no idea what they do for a living or whether they can actually repay. This is what's called asymmetric information. Banks solve this for you. They assess borrowers' ability to repay and safeguard your money. Looking at the bigger picture, banks are the channel through which monetary policy is applied to the entire economy, maintaining the value of the dollar, controlling inflation, stabilizing, and developing financial markets. In the US in particular, banks are even more important, managing massive household deposits and providing capital for businesses. A change in interest rates can mean the difference between a company thriving or going bankrupt. But with so much money under their control, can banks go bankrupt? And what happens then to the financial market? We know that banks are huge and complex, so failure isn't easy. or at least not as easy as we might think. Yet in the US, it can happen, like with Silicon Valley Bank in 2023. At that time, depositors feared losing their savings. But the US has the FDIC, the Federal Deposit Insurance Corporation, which guarantees deposits up to $250,000 per individual account. So if a bank collapses, you still get your money back within that limit. The losses mainly fall on investors and shareholders, not small depositors. The real danger in such cases is the loss of public trust in banks. And in a system built on trust, that's like cutting off your own lifeline. A domino effect could follow, with people rushing to withdraw cash from other banks. And in reality, there is no system strong enough to survive a mass withdrawal all at once. That's when capital crises and economic crises can erupt. That's why the Fed and the US government will do everything possible to prevent chaos. And those are the basics about banks that we should all know. To sum up in 3 points, as of now, the main activity of commercial banks is still taking deposits and making loans. Banks have many ways to generate profit, making cash flow management extremely complex.
Banks are giant financial intermediaries that run largely on trust, yet remain a crucial link in the US economy.
Hopefully this video gave you a clear overview of banks. If you'd like me to cover another topic, don't hesitate to comment below. I'm Luz, don't forget to subscribe so you don't miss any videos. Goodbye and see you next time!